Yeah, Eric, well, welcome back to Chat with Traders.
Great to be here. How are you?
Okay, fantastic. Been watching a lot of your videos,
I
getting in the
love
weeds in GameStop, and yeah,
GameStop. Oh man, I gotta tell you that product has been so fascinating for me. It came up on a couple option scans. I have stuff that's running all the time that's just
Mhm.
looking for things that are weird to some degree, and it popped up earlier in the year. It's like started emerging right in the beginning of May, and I was just like, what's going on here? And then I just remember the first time I played the squeeze in GameStop, it was on the same exact thing as it was like 2021, and it just
Mhm.
started popping up, and I was just like, I mean, I'm always down for a degenerate trade. So I put some money out there and I just start trading it. But yeah, GameStop has been fascinating. I think it's a grossly misunderstood product, and there's a just incredible amount that people can learn from it, even if you're not like, I think this idea of like dismissing them as meme stocks,
Mhm.
it's so, it just doesn't make sense to me. And I think that it diminishes a lot of what people can learn from them. Now, there's always balance, right? Like, do I think that these are the things that I would be putting my entire portfolio in and hoping that it goes up?
Mhm.
Probably not. But I also don't dismiss the fact that there's opportunity in stuff like this, especially from an options trading perspective. Even if you're selling vol, I mean, there's just a lot to do in there. So yeah,
Mhm.
GameStop has been one of those really quirky ones to keep an eyeball on.
Yeah. So how does it pop up on your view? Do you sort by biggest movers, or does IV have to hit a certain percent before it pops up on your radar?
Yeah, that one, it came on for a few different reasons. So there was a really unusual expansion in underlying volume. So that was one of them. The options chain started to go off the chain. And I started seeing like a lot of repeat purchases at specific prices, same lot sizes, pretty similar timing. And it's like something's happening there, right? Like you don't have somebody that comes in that's throwing in the product at the time that was essentially quiet. Not much was going on. And then all of a sudden, I'm starting to see like 1,000 lot, 5,000 lot contracts come through. And I mean, like they're banging. It is consistent, consistent, consistent. I'm like, that's something. Like, I don't know
Mhm.
what it is, but I could tell you it's something that's not normal for, again, like what it's been doing previously. Because as soon as it starts popping off on some of these different alerts, what I'll do is I'll look at the history and I'll say, what has it been doing? What's the latest news? Because especially something like GameStop before this most recent move, I wasn't necessarily diving straight into it because I had been following it super close. I always, remind people like I'm a trader. I'm about as disloyal as they come. If the activity's over here, I'm over here. If it's not over there, I leave and I go over here. Like I don't really care where it is. I just really need action. I need movement. I need volatility to some degree, no matter what I'm doing. So for something like this, as it started emerging on some of the different scans, it just looked really anomalous. And I really like to look for products like that. You can use things like I was talking about, really big expansion in underlying volume. That's typically part of it no matter what. You can look for big changes in price that are typically one direction. So if you're looking on a chart, it'll kind of be these big candle bodies with these little tiny baby wicks. It just tells you that people are generally one-sided on what's moving there. For the options specifically, persistent buying in a specific option cycle at a specific strike, that's pretty telling. For somebody with some sort of informed position, building a larger position. Now, I always caution people with that because you have to be careful. You never know what the rest of somebody's book looks like. So sometimes people will say, like, oh my God, they're selling a million calls. This is bearish. And
Mhm.
the position itself could be bearish. It could also be part of a covered call position, which is actually bullish. Max profit is above the short strike. So it does require a bit of a nuanced understanding of like what makes sense and what looks normal based on a circumstance. But another great one is volume is greater than open interest. That tells us that
Mhm.
a specific series is getting hammered bigger than obviously it had been previously. There's lots of different things that kind of start to key up expansion, and vol is another really big one. It's one of those, that's what made GameStop so funny too. It's not like it just popped up on like there was like insider transactions or like one thing. It was like everywhere. Like all of my scans that were coming up on the day, it was coming up for something. And I was like, it was like CrowdStrike recently. CrowdStrike came up, like I couldn't not see it in something. I was like, yeah, okay, I got it. CrowdStrike is dying. Let me see something else, please. So a lot of those things are looking for those kinds of activities, though, just stuff that is ruffling the status quo to a degree.
Well, I wondered, since there's been a big expansion in options trading over the recent years, and I'm wondering to what degree are the options wagging the dog, the tail wagging the dog, in the sense that market makers needing to hedge their exposure and wanting to remain delta neutral are how often and can the market makers be the primary driver of buying the stock, even more so than the retail apes, as they call them, just to hedge their exposure from all the apes buying these out of the money call options?
Yeah, so that starts to describe a function where we would differentiate this notion between a short squeeze and a gamma squeeze, where gamma squeezes are going to be driven by market maker hedging activity. And to your point, there's an element of that. Now, I would never pose myself as the like sophisticated explainer of that entire world. I'm familiar with it, but from a market making perspective, there's different ways you can hedge positions, right? So they're not actually super incentivized to be hedging a bunch of out of the money positions because it drags the portfolio to carry that hedge, and they can use other products, other options to scrub that risk off. Now, when it comes to purchasing of the underlying, obviously that will occur as we're nearing expiration and as options are in the money. In those scenarios, there's a really good chance you're going to have to deliver, and they need to figure out a way to execute delivery, often with the underlying. But even that goes into a whole other wormhole that you kind of figure out different ways that they can try to produce delivery, but it can kind of pull from other areas leading to FTDs. That world gets really deep really fast, I think. But the Cliff Notes version on the original thought, though, regarding the tail wagging the dog, I definitely see that there's the ability for that. To what degree is difficult, and sometimes it does require us to be at a bit of an extreme. But again, like that's the nature of a gamma squeeze, is that's being led by market makers. Now, how it happens really, it's interesting because it requires a lot of options that are staggered across different strikes. Because as options fall in the money nearing expiration, we now have to find inventory to, again, hedge this position fully if they're choosing to hedge it fully. And if that's all there is, well, then the buying pressure stops. There's no reason for them to start scooping up tons of more shares in order to drive price up more. So, however, if in the process of hedging these newly in the money options, that moves us up half a point, and now all of a sudden there's another strike that has a bunch of OI that now also has to be hedged, right? So it kind of requires this progression to be there in order to force them into this sustained buying pressure. And you can also see the way that options can lead the market to a degree in terms of things like net gamma is another great example of that, where based on dealer gamma, we can surmise how they're going to have to hedge their positions. And sometimes if they're hedging certain gamma positions, they have to buy. So then we know that that might nuke some of the volatility that we see, which sometimes there's the inverse, where they need to sell in order to hedge their gamma, which tends to exacerbate volatility. So there's a lot of little instances like that. I still tend to like to think that the primary driver of price is supply and demand, kind of simply from that sense in the purpose of price discovery. But something like GameStop is very strange, and it has a lot of quirks in terms of how it moves. It's actually become a fascination of mine over the last couple months. I've just been learning a lot about it because it just moves so different.
Uh-huh. Do you ever use gamma information to help you give you kind of confirmation of anything you're looking at?
It depends in what context. So if we're using something like dealer gamma, yeah. like it's slightly informative to me, but that's not something I tend to focus on really heavily. Something instead like gamma when I'm selecting a specific position, absolutely. That's a massive input, because when I'm looking to buy options, I need to make some choices in terms of what makes the most sense for my options position. And gamma is a massive part of the ability for a convex payout. So yeah, gamma in context of an individual Greek, highly, highly important. The gamma of a portfolio level, even from a portfolio management perspective, is also super important, because that'll tell me how fast my portfolio can move. And depending on my risk tolerance or aspirations at the time, it may or may not line up. So even in that context, I think it's really important. When it comes to dealer gamma, if I traded really short-term timeframes and stuff like that, I think it would become more pertinent to me, but I tend not to. And I think that once you zoom out a little bit too far, there's a lot of other introduction of market forces, new information, overall market trend, yada, 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 that can kind of overwhelm that effect. But dealer gamma is pretty well studied. You can look it up on SSRN. I reference that all the time. It's a fantastic social science research network that lets you pull up different studies. And just for anybody that ever looks at those, you have to take it in context. A lot of them are collegiate in nature. They're not always like direct representations of markets. I just see people go into those studies and they try to directly apply it to markets. And they're like, why is this so different? It's not going to carry over perfectly, but you can use it to gain a lot of information. And there's quite a bit of research out there about something like dealer gamma.
So do you see this phenomenon happening in any other stocks other than GameStop, or is GameStop pretty unique? Because it's been, what, 3 or 4 years since we've had the last meme stock craze. And during this recent run-up, we had a little pop in AMC, but it seems like GameStop garnered the most attention. Is this extremely rare, what happened with GameStop? Is it just kind of maybe once every 3 or 4 years, or do you see this occur multiple times a year?
It happens a lot in different stuff, but there are different reasons. So if you are an options trader and you spend time trading vol, you'll spend a lot of time in super nasty small cap illiquid biotech stocks, just in the sewers. And you'll see stuff like this move in there pretty regularly. I mean, that's part of the reason why there's opportunity and stuff like that. So it's not fully novel in terms of just price behavior. I would say what's novel about GameStop a little bit more than some of these other products is what's moving this. Because for a biotech stock, it's pretty clear, right? They go through some sort of phase trial release. It went good or did not go good. And then based on that, the stock will fly one way or the other. It's pretty clear cause and effect in that scenario, more often than not. Sometimes a little more nuanced, but generally. Something like GameStop just starts going up. You're like, why? Why is this going up? And then you find out that there's a really big community movement where they're looking to lock up more and more of the float, which is hilarious. I love that. It's so cool to see a community get together like that and be like, you know what? I think we can do something here. And because they're doing that, it decreases liquidity in it. So then as a dealer needs to hedge their risk, they're working with a limited pool of resources. So then all of a sudden you have less to grab from. When everybody's trying to grab it, that starts to move price pretty meaningfully. So in that sense, I think GameStop is probably quite unique. I don't have a metric off the top of my head, but I would be curious in it to see what other companies have the like higher DRS share pool than something like GameStop. And for those that are unfamiliar, DRS is just the direct registration system. So essentially, when you buy stock, you don't actually own the stock. The broker owns the stock. And then you have an agreement with your broker. Whereas if you DRS it, that means that the shares are put in your name. You now own it. The broker cannot loan your shares out for you. They can't do anything with them. They're your shares. So that's what DRSing does, and it decreases liquidity because now as the broker can't loan my shares to somebody, they can't do anything with them because they don't hold them. I do. And I don't know many other products that have like such a focus on a large number of holders doing exactly that. So I think in that sense, it makes it fairly unique to this product, but I'm sure there's others out there that might be similar, but that's very specific to these.
I've heard many of the GameStop longs argue about uh, naked shorting and failures to deliver. What
Mhm.
is this? You know, is it real? Is it something that is it a real problem to be concerned with?
Yeah, definitely. So one of the reasons why that community has become so sensitive to it, and I just want to preface all of what I'm saying is that I'm new to all of this background. So a lot of what I say is still taken in the context that I'm learning. I don't want to sound like I'm the authority on it because I'm not. I am right now very heavily a student on it. But the world of FTDs is fascinating, and there is a problem with stuff that deals with GameStop. And the reason why the community has gotten so focused on it is because from the last squeeze, it kind of landed at we thought or were told that all the shorts were closed and this is all done. You guys had your big win and it's all good. Let's all move on now. And then you start looking a little bit deeper, which is another one of the things that I just cannot get enough of with the community. They're fascinating. It is the perfect description of like the hive mind because people start finding like, wait a minute, this brokerage company has a bunch of swaps that seem to deal with GameStop with these people. What are these swaps for? And you start going down the rabbit hole, and it does look like to a pretty significant degree that a lot of the shorts did not actually close, that they entered swaps to essentially defer the positions, and they're carrying these swaps into the future, which is fascinating. And a lot of us are still trying to figure that out. There's probably people way more educated to me on the expect of the unwind of it. But the fact that that even exists is pretty interesting to me. The other thing that you find that's really curious with something like GameStop is a really vicious cycle with ETFs and creation and redemption. And there was a Wharton professor, I want to say, that did an entire presentation on this that is also highly fascinating. Actually, let me see if I can find it for you guys so that you have it for your reference. And essentially, it looks like there's a way for different entities to balance FTDs by going through these ETF creation and redemption cycles. So now what we're finding is that there are relationships between stocks like GameStop and its FTDs and ETFs that hold GameStop and its FTDs and volume. And you start to realize like there's a big juggling act going on right now. And I think a lot of the community is pretty privy to it. And they're learning a lot more about the market mechanics behind how these kinds of entities have to manage their positions, how they have to work on delivery cycles. And all of those kinds of things can have impacts onto the price performance. So stuff like FTDs, failure to delivers, it's a really big part of the story actually, and it extends not just to GameStop, but it extends to other peripheral products that also deal with GameStop, like these ETFs that I'm referencing, that you can see their FTDs move and their redemption creation cycles move, which again, it's fascinating stuff to me.
But aren't failure to delivers only connected to entities which try to short the stock? ETFs don't try to short, correct? I mean, aren't they just strictly long?
It depends on the ETF, but more importantly, to your point, the majority of them, that would be the case. But and that's why this video on naked shorting is really important, is because there's a way where you can essentially crack open the contents of a basket ETF and take out the internals and then use those internals for things. That's why the ETFs get wrapped into this whole scenario. I'm going to share with you a video. I'll put it in the chat here so that you can share with the broader audience. But this was just a fascinating. It's like a 20-minute presentation. You could play it on 2x speed, knock it out in 10 minutes. And I just lied to you. It's a 40-minute presentation, 2x speed, knock it out in 20 minutes. And but it talks about this entire cycle and how it works. So yeah, I think the short selling component has been widely supported and perpetuated. I don't like going too far down the rabbit hole saying like it's all rigged, it's all crap. Like I don't feel like that. Otherwise I wouldn't be in the market. But I do see elements of it that make me question components of how legitimate some of these things are, especially when you layer on other things. Like it's hard to argue that there's a lot of price discovery going on when there's so much dark pool volume. That doesn't necessarily help us that much with price discovery. So it's like again, the more I talk about it, the more I realize it's just like this. If you do like a fishbone diagram, you just go off all these offshoots on all these weird little things that add up to make it the just fascinating scenario that it is.
So these interesting or fascinating aspects to GameStop in particular, does that change your strategy on how you play GameStop, or how did you play GameStop, and how did it differ from other stocks which are more plain vanilla that may also have had a high IV? What was different, or what did you do?
Completely different. Yeah, it's completely different. The way that I trade something like GameStop is completely different than a way that I trade literally everything else. And it's because of the way it moves, and it's because of the profit mechanism that I'm trying to capture. So in something like GameStop, the profit mechanism that I'm looking to capture is some element of upward price movement due to limited supply and excess demand. So short squeeze, gamma squeeze, whatever squeeze you want to call it, I don't care what kind of squeeze it is. Something being parabolically shoved up because of this function is interesting to me, because it creates a highly convex, asymmetric risk reward profile. Now, again, when I'm playing stuff like GameStop, I split my portfolio into two buckets. I have my core allocation, speculative allocation. This would live in the speculative allocation, which has much tighter risk controls. And this would be sized down massively because of it. Because just as this thing can go from 10 to 60 over the course of a month, it can go the other way. It hasn't yet. It went from 60 to 25, but not that far off. So I don't play this with something that I think is not earmarked for heavy volatility. The other thing is I do not want to be short options in this essentially at all. I have no problem right now. I have some short calls against long shares, and even those, they make me nervous. I have them really far out in time, because one of the things that really makes me nervous is if for whatever reason there's a giant squeeze and there's short dated calls and then they get exercised, and then I'm now short shares. I have the shares in the account in order to offset them. But if I didn't have that and I was just selling, naked strangles or straddles, which is one of the ways that I would try to take advantage of volatility, I could tell you what I don't want to be: short shares in GameStop during a squeeze. No interest in that. So I will not trade the volatility in this anywhere near the way that I would trade the volatility in standard products like biotech. Those kinds of things, I'll put on a short straddle, short strangle, whatever it is, and I'll just size it, expecting there to be a massive move, because those things can move big. And then there's no problem. It's kind of okay, because they're not being driven up to $500. That's just a different ball game. And that's something that we saw in something like GameStop. So I treat that with a very different level of respect than something like I do like those biotech stocks. So that's just from a short option perspective. And from a long option perspective, I'm really thoughtful about the way I structure those trades. I literally just ran a bit of a campaign from the beginning of July up until like mid-July, just a couple weeks ago. And I was using long options just for some directional leverage to the upside. And funny enough, if you look at a chart of GameStop over that period, it essentially looks like it did nothing, but it actually went up 20%. But it doesn't look like it because of the recent magnitude of those other moves. It just squishes down the recent moves if it's not a log scale. And those kinds of things, I'm really thoughtful, because as something like GameStop becomes super volatile, the bid-ask spread on those options you could drive a bus through them. So sure, you might be there making buku bucks, but can you actually get buku bucks? Probably not. Like, you are going to get scalped trying to get out of those things at anything even resembling a fair price. So this is another example of how I trade this so differently, is that my primary profit mechanism, which I referred to earlier, upside price direction, I use options to amplify it, but the base position is long shares. It's literally for liquidity, because I do not want to have this handsome profit on these long options and just get murdered by the market makers out there taking haircuts off of everybody. They're like, sure, I'll provide you a market. There's a market. You're not going to like it.
So did you go back in May when it had its first run up? Did you go covered call type strategies, or what specific strategies did you implement?
Long options.
Oh, just straight long calls.
Yep. Long options.
Oh, wow. So you were not dissuaded by the incredibly high IVs?
No, it's IVs are tricky. And I find for options traders, sometimes they can become too wrapped up on those details, right? Like, you're told if IV is high, you shouldn't buy premium. Don't buy premium if IV is high. The problem is IV is still secondary in that function. If there's a giant move, it doesn't matter if you overpaid for your IV. You overpaid for it. It was too expensive. But if you get the move, it can pay you out. So it's the kind of thing that you have to be thoughtful about. I would never say, like, don't ever care about IV when buying premium. That's stupid, right? If you have something that's not moving that much, but IV is high, you have to make a decision based on the thesis. But for something like GameStop, the thesis there is pretty big upward price movements. So the impact of IV still is there, but it's mitigated to a pretty significant degree by the delta move, which just grossly overwhelms the IV impact. The other thing is, as the underlying skyrockets up, the IV isn't contracting super fast. IV is expanding typically even more. So you even get a bit of a kick in the trade from the continuation of IV moving in your favor. The other thing is the base profit factor, or the base position to capitalize on the profit mechanism, even in that scenario, was long shares. I add long calls on top of it, again, because they add leverage, and it gives me a way to get way more exposure than I would otherwise have to commit capital to through long shares. So there's still secondary in that sense, because it is so massively volatile. When you're at those kinds of peaks, you have a lot of stops going on. The market is halting. So then it's reopening and flying. Liquidity is not there. So options are really, really tricky to trade around those kinds of events, especially if you're not just holding. If a big part of what you're doing is trying to profit on these movements with the options, your biggest profit is typically going to be when things are most volatile, meaning it's peaking on this giant squeeze to the upside.
So how were your strategies impacted, or I should say, did you switch or modify your strategies when you got the first news announcement that they were doing a secondary offering back in May? And then also again in June, when they announced their second round of a secondary offering, a big, massive dilution, share dilution. And the stock went from hard to borrow to easy to borrow. Is that for you? Was that or I mean, how much of that was a kind of like ringing a bell as far as getting out of the long position?
So the majority, majority of the options I had already exited. So at that point, I went through a cycle where on the 13th, the 14th, the 15th, and the 16th, I essentially scaled out of all of the options. At that point, I essentially was holding long shares. And the long shares I had gotten into towards the beginning of May. So they're like, maybe I'd have to look. I would guess they're probably something between like 14 and 15 bucks. So the at the money offering and stuff like that, at that point, I didn't really care. I actually think for the company, as annoying as it was for the people that are like really fingers crossed hoping for a squeeze, I actually think it's good for the company. They erased a massive amount of their debt, and now they're sitting on billions in cash without a big debt profile. So I think from like a management perspective, that was actually really well done. And I think that's one of the things that's tricky with something like GameStop is there still is an underlying business here. It's not just this thing can be manipulated and squeezed or suppressed or anything like that. There is a business there. You can go to stores. So part of that I actually thought was probably annoying for the people looking for a squeeze, which I understand. But for the business, I mean, shit, if you could wipe out a massive amount of your debt in that kind of offering, and again, like there was dilution, but it wasn't crazy. They didn't have to offer an insane amount in order to essentially get the debt off the books. So I thought it was actually a pretty strategic move. So for me, for the shares, I didn't care at that point. Mattered to me, not at all. And then for me, it wasn't really anything I was playing with fervor with options at that point. So like the move that we saw in the beginning of June, I participated minimally in that. And then I played a little bit of this July move. And throughout all of this, I'm essentially still just using long shares as the anchor of the position. I'll sell calls against those shares because the premiums tend to be really elevated, especially when I see the IV. If I look at a volatility, really it's kind of like Smile in this case, but if I look at any sort of depiction of volatility surface, you can find periods where the call side IV is just massively priced compared to the put side. Great time to sell some calls against the long shares. And there's lots of opportunities to continue managing that position to pull in the vol from that side. So yeah, in general, didn't really impact my book or what I was doing much at all. I thought it was good for the company.
So switching gears a little bit, another
Yeah.
stock in the news that had very high implied volatility was DJT, Delta Juliet Tango. And I noticed that the back when it was having its run to 60, 70, right around there, I noticed that the at-the-money put prices were around 4 times or more expensive than the calls. How does this type of imbalance occur, and how often do you see it?
Yeah, well, something like that, it's put skew is not abnormal, right? And in this case, I'm not referring to the OI or volume part of the equation, but I'm referring to the vol pricing. The market in general is going to fear the downside more than the upside. So in most products, you'll find some semblance of put skew. Even if you look at SPX or SPY, you'll see that the puts tend to have higher vols than the call side. Now, to that extreme is another story, right? It's that on a pretty magnified level. You'll see that sometimes in things coming up on earnings, big corporate events, big corporate news. So it's not anything that's like overly crazy to me, especially with the way that the product was moving. It seemed to me that it was almost warranted because of how crazy it tends to move. But stuff like that can be tradable. I find that you have to be so very careful about how you choose to try to trade it. Because again, even the vol side of the equation is part of it. But then if there's a realized move that takes you out, even if your vol projection was good, you still get killed on the delta move. So something like DJT has been fascinating to watch. I have not traded it much, and it's not because of any other reason that I found better opportunities for what I've been looking for, but this has been one that's popped up a couple times. I did try to trade it around the 15th, and I just got knocked out immediately. I was trying to trade short vol in it then, and it just had this giant move. I was like, man, the vol here is just so rich. I knew, like, I could see the train coming, and I'm just too much of a rote trader. I'm like, here I go in front of this train. I got to do it. And I just got ran over. But something like that, I think for vol traders, especially a product like this, it's a really strange one because it's obviously a company with a business, but it is so heavily tied to a persona. That's a tough thing to trade, in my opinion. So yeah, it tends to behave very strangely, I think, for those reasons.
Have you noticed a correlation between hard to borrow stocks and high IVs for at least for the put side, like being very difficult to borrow drives people into buying the puts instead of just shorting the shares?
Yeah, definitely. So a borrow fee is a pretty strong predictor of stock prices. We know that. And that gets baked into option prices. So I think that you'll tend to see a relationship between those, and specifically in terms of volatility, absolutely. Stuff that becomes hard to borrow tends to be hard to borrow for a reason. So yeah, I think that that's a completely fair analysis to come by. And that's another one actually that there's a couple really good papers from SSRN that are on that. One of them is called, I think it's an older one, but it's like dynamic model for hard to borrow stocks. And then there was another one about stochastic pricing. I think those are two pretty good studies on the impact of hard to borrow status. But yeah, that it's a informative function of stock price for sure.
hmm Um, and then also, I noticed that when attempting to short DJT, that the daily borrow rate was in the hundreds of percent
Mm.
annualized. How is that calculated? And I mean, who's setting those prices?
That's a great question. Do you know what period that it was running that high?
It was recent. I mean, it was recently. I think it was in the 50s at the time. It's within maybe a month. 6 weeks ago. I forget exactly which, but
Got it.
within the last 6 weeks.
Got it. Yeah, because I mean, typically speaking, the brokers are going to determine what the rate is for them. How they arrive at that, I'm honestly unsure. I don't have a great
hmm
sense of it, but I know that they are typically the governing bodies on what they choose, because of the again, like it's their shares technically, so they're deciding
hmm
who they're going to give them to and at what rate. But yeah, to me, that sounds like a standard broker being a broker, where if they see perceived accelerated or heightened risk, they're going to demand compensation for it. Or if they see an opportunity to take advantage of a supply demand imbalance, they're going to take advantage of it. So, yeah, I mean, to me, that sounds not shocking at all. I don't know the specifics, though, on how they're running through the calculus within the brokerage firm to arrive at that price. I would probably take a scientific wild ass guess that it is largely supply and demand related.
hmm Recently, actually, I went short the shares on GME, and I noticed that the buying power
A bold
required
move.
was 300% higher than the proceeds I received from the short sale.
Mm-hmm.
While many mainstream stocks, like say airlines and home builders, only needed 30 to 40% more buying
Sure.
power than received from the thing. Why does this occur?
Yeah, it's literally what we were just talking about. That is the broker trying to cover their ass. That's actually the broker giving you a healthy heads up that you could have your face ripped off. So the way that the margin requirements work on stuff like that really boil down to a broker's perception of risk, right? That's the whole point of margin. They want to
Mhm.
give you the ability to trade more, but you had better believe that they're not here for charity, right? They want you to trade more so they can make more money off your money. But what they're not going to do is take the risk for you. So if you're trading something that you've recently seen gone from 10 to 65, or something that's gone from 10 to 20, which one would I perceive more risk as a broker? It's obviously the something going from 10 to 65. So that the entire reason why the broker is demanding that from you is to cover their risk. They do not want you to become insolvent if this thing experiences a really large move, so that they can get their money from you, as compared to having to reconcile with the OCC directly out of their book.
hmm So then, um, is there a way to calculate the amount of potential future buying power required as a stock, say if one is short a stock or short the calls, as the stock moves up, the amount of buying power required goes up because they raise the requirements, and so becomes this massive expanding scenario where it just like a black hole, it sucks up your buying power like crazy, even though the amount that it went up was not didn't seem to justify the amount of buying power that they suddenly require.
Yeah. The thing to remember about the movement in margin requirement is it's based on the broker's perception of risk. That's
I
what it's
see.
based
Uh-huh.
on. So as soon as, whether it moves 5% in one direction, we might look at that and be like, it's just 5%. We're okay still. The broker might be looking at, oh shit, is this thing getting ready to make a move from this 5% move to literally a 200% move? I'm not going to get overran by that. So the way that they calculate the margin requirement is standardized. You have to look at your individual broker, but you can ask them, how do you calculate your margin requirement for this position? And then it will differ. If you're on Regulation T, which is generally standardized, it can be more restrictive, but it's generally standardized by broker. Or if you have portfolio margin, which is going to be more proprietary to the individual broker based on the way that they choose to calculate portfolio margin requirements. That's one of the benefits of it, is that it's a little less conservative. It's a little more based on perceived reality of movements. So it tends to unlock a little more capital. But both of those will be completely available to you from your broker. And you literally can just look at the way they calculate it and then run the numbers yourself. You might have to make a couple assumptions depending on, if you want to include some sort of volatility component to it. But a lot of times you can just use the stock price movements and stuff like that.
So I've often looked at different kind of returns possibilities on vertical calls and vertical puts, and quite commonly I see that for a stock, we're going, if the stock is trading in the middle of the two strikes approximately, that it's not uncommon for the net premium to pay out to be half of the maximum that you can receive. So a $5 spread in the option prices quite commonly can be bought for $2.50 more or less, right? So in other words, it doesn't take much of a move for the stock to receive 100% gain at expiration. Now, when I was looking at DJT, for example, when their option prices were totally skewed, that even doing verticals on that yielded a horrifically low number, meaning that the amount that you had to pay up was very high compared to the amount of return, disproportionately compared to other stocks that you'd commonly look at, maybe a vertical. Do you know why this happens? I mean, because the IV was high across the board, so you would think, well, the cost of the more at the money put is high, but then the cost of the out of the money put should be equally high, and it should balance each other out.
It's funny because you're actually answering your own question there. So if you think about it in the context of the way that they're pricing those options, the way that they look at them are different, right? So if we're looking at a volatility surface, so exactly to your point, that is what I would also tend to expect. I would expect to see a volatility surface where, and that's another, actually, side note, an interesting component about options is that typically speaking, the further out of the money you go, the more vol they tend to get. So just another interesting function of them. But essentially, if you were to visualize a volatility surface, it would be what you're identifying there are kinks in the volatility surface. That's what that is. So instead of it being this uniform curved flat line gently sloping, it's showing you that here it's at this point, then it jacks up to this point, then back down to this point, and then maybe flat a little bit and then up at this point. So I actually can show you, I don't know if this comes through for you guys, but I can show you really quick what literally exactly what this looks like, because it's a great question. And it's this. So if I just use the average, so it's a little easier, maybe we'll use like that out of the monies. What you're looking at is it's exactly this. So even though, like if we look at a normal product, let's pick something like GE. Kind of normal. They're going through some stuff with earnings. Maybe not the best example, but more smooth, I suppose. So here I'm looking at two different expiration cycles, but you can see that there are a couple of like these random kinks where, okay, so vol for these 141s is actually quite elevated compared to vol for these 140s, right? So that can lead to that pricing discrepancy that you're talking about. So again, this is a little kinky for just because it just went through earnings. But if you look at this even compared to something like DJT, which does not have earnings, this looks like you handed a child a crayon and told them to go color. And so that's exactly why you see the disparity as much as you do. It's for this exact reason, because the vol across the surface is this snarled, jagged tooth thing. And it's because everybody is making these wild guesses as to what vol may or may not be, should or should not be. And the market is not at a uniform consensus. This is more standard for a volatility. This would be like a volatility smile. And in this case, notice how it's way more smooth. It does have this strange kink here. Normally you wouldn't see that. Normally it would just kind of continue ascending in this fashion, but this is way more normal than this. So one of the things you can do in that kind of scenario is just look at a different expiration cycle, or look at the volatility surface and see like, okay, is there something squirrely going on in the cycle that I'm looking at?
I see. And so do you use those graphics that you were showing us
Of course.
to kind of cherry pick the optimum kind of combination
Of
of
course.
options? Mm-hmm.
So I use it more so from a volatility trading perspective, because I have a generally deep-seated hatred for verticals. So I avoid them almost like the plague. Not quite. I still trade them sometimes. I just like to be a little more hyperbolic about them because I think they're terrible. But
I'd like to push back on that, if just be devil's
yeah,
advocate if I could.
I would love you to. Yeah, I'm
Yeah.
always down to fight over some verticals.
Yeah. So, okay. So a trader who looks at a stock and thinks that it will go up a little bit, but is not
Okay.
expecting it to shoot the lights out, right?
Okay.
Can say, well, instead of just going straight long the stock or straight long a call, I think it'll just go up to this level or higher by the expiration date, say a month, a couple months out. So they say, well, I'll go long the more at the money call, and I'll go short a slightly out of the money call. And the premium most of the time is not uncommon to get, a roughly 2-to-1 ratio, meaning for a $5 strike price difference, it's not too difficult to find one at 250. So in that regard, say, well, the stock only has to go up, maybe 5-10%, maybe 15 at max for me to get a double by the time of expiration. So that would seem to be a fairly conservative play, right?
Yeah, I fully agree with you in that scenario. I think I don't hate that. I think when I trade options, I look for the simplest expression of the thesis, and I do a thing called, I look for no's. So if I'm looking at a stock that I think is going to go up, but I don't think it's going to go up that much, go to something else. Go to something else that looks better. Like, there's no reason for me to force something that's somewhat acceptable in this one position. I would rather just go find something else that's a better trade. Now, let's say that we find something that we're just really drawn to. It has some sort of, component to it that we really like. The problem that you'll find with vertical spreads in that sense is that the overwhelming majority of instances, you're dealing with something with negative expected return right from the jump, right from the get-go.
Why does it have negative expected return?
Because of the cost associated with putting on the position. You're taking too much of a haircut, typically speaking, based on the probabilities of it making the moves that you need it to move. That's the trade-off, right? Otherwise, verticals would be the greatest thing on planet Earth, right? I would trade them. I would have nothing wrong with them. But you have to think of it in the sense that they have defined risk. They're generally still higher probability plays than some of these other, choices out there. And they're great. They're super efficient in terms of capital. I mean, that sounds like everything's great, right? But that's the problem, is anything in the market that has that kind of appearance is going to have some sort of drawbacks. So that's a primary reason for the drawback. There's rarely an instance that I could point at and say, this would be better with a vertical. I don't think of, even in that scenario that you just gave me, I would rather just buy the option. If it's going to make a 10% move, I can still make more money. Now, to your point, you will make a much better return on your invested capital. But this is where it comes into the balance, in my opinion, of always keeping a pretty good weighting between percent returns and gross returns. This is the same thing with buying super far out of the money single option lottos. You get it for 2 cents. You can get a 16 gajillion return. That's probably a little too big. They'd probably make a bunch of money. You get 100% return on those options. That sounds great. Okay, take your $4 and go enjoy the rest, right? Like you got a great percent return on that invested capital, but as a gross dollar amount, negligible. Who cares? So I look at both of those in context. If I'm in a scenario where a vertical makes sense, and like I said, I do trade them. I like to trounce on them any opportunity that I can, but I still do use them periodically. But most of the time I use them to protect positions that I'm nervous about. So for example, if I'm trying to trade in earnings in something like Meta, and I want to run a short strangle, I'm probably going to cap the upside. Because you can find instances of these really successful tech companies, it's not limited to them, other companies, where they can just get these massive up moves and never come back. That's difficult to manage with a naked short call, because you could say, well, I'll just eat it the next day and take it down. But if it's this big giant gap up, again, you get your face ripped off. So that's not great. You could say, well, I'll manage it by rolling it out. Maybe I can roll it out and up and out and up. But if you have this thing that never has a downtick and it just goes up into perpetuity, good luck doing that. So there absolutely are use cases for them, even from a capital preservation or from a margin preservation perspective. I think they're okay but for me, I would just go way wider. I wouldn't want to do $1 wide, $2 wide, $5 wide. I would just widen it out as much as I can, treat it as if it's a single option, but then add a wing to it so that I can decrease the margin requirement if I had to do it.
I see. And what do you look for in the underlying stocks to potentially trade? Kind of what's in your typical watch list?
There's a handful of like primary profit mechanisms that I look to capture. So I'm looking things that are exhibiting price movement up or down. And I'm looking for things with volatility movement that I think either will be up, down, or sideways. So there's kind of those main buckets that I'm typically scanning for in different ways. So the way that I decide like how I'm looking for a position always starts with looking at the market. Really, not to be too esoteric, but it does start with like a general economic understanding. So like right now, I know inflation is still high. Does that mean that I'm going to want to jump into small regional banks at this moment? Maybe, but probably not, right? So like that higher level, just general understanding. You could spend very little time on economics. Some of it's interesting to me. Most of it's probably useless in a practitioner standpoint for traders. But I'll start there for a general understanding. Then I'll look at the market. What's the market doing? Are the indices moving in line with one another? Are they wildly diverged? This recent move in the rut, I've been waiting for it literally for 5 months now. It finally showed its head where the rut essentially has made all of its year gains over the course of a couple weeks, right? But that's just a market cue that I have in my brain. The rut is wildly lagging, high inflation, generally suppressed. When we start to see likely some change of the rate picture, I imagine small caps will go up. I actually had an interview with Business Insider not too long ago talking about that exact thing months ago, just waiting for it. And so that's like the next layer down. Then I need to look at the portfolio. Based on those first two scenarios, I look at the portfolio. What do I have in there now? And how does this align based on how I feel about these other things? So after the end of that process, I'm pretty much backed into what I need to look for. So if I look at the portfolio, my overall disposition right now is bullish. I want long deltas. And I look at the portfolio and I'm kind of like flat deltas or maybe even short deltas after I take some old trades off. Now I know exactly what I'm looking for. I need long deltas. So that's like from a portfolio driven perspective. If I open up the portfolio, it looks how I want in conjunction with those first two levels. Now is the fun part of being a trader. I get to look for opportunities. I get to look for cool things. So that's when I'll jump into all the scans. I don't really care if it's something that's breaking out to the upside, breaking down to the downside. I don't care if there's something that has really great variance risk premium opportunities for me. I'm agnostic. I'm just looking for opportunities. So then I'll start scanning for those kinds of things. So the summary of that is it starts with a high level overview of the economy stock market portfolio. Then I have two decision trees. I'm either looking for a portfolio based need based on that analysis, and I already know what I have to look for. I need I need to have some sort of positive theta coming into the account because I have too many long options and I'm bleeding theta on a daily basis. I want to offset that. Now I need to go shopping for that. That's the portfolio side. If it's an opportunity driven side, I literally just have the luxury of looking through the market, looking through different scanners and seeing what looks interesting to me. Great example recently, this whole CrowdStrike thing. I was looking at it when it first fell off a cliff. And then I had, when it was hanging, what was it, on the 19th, it was just like floating. I can share my screen so that we're looking at it together. So it was just floating here. And I didn't have a great sense on what I thought about it at the time. It had just coming off this, obviously dropping this terrible news, and we're still figuring out how bad it is. So is this where I want to go long? I don't know yet. But what I can tell you is that I do think once the bad news in this is starting to kind of like settle down, I do think that this will rebound. I really do think that. And the reason why I would think that is I just view price extremes as kind of like these big rubber bands. And once they're extended too far, sooner or later, they want to snap back. And really all that means is that there are people that want to buy at this price. And it's actually happening today. I haven't looked at this yet, but it's literally happening today. So what I did here was set alerts to the upside and the downside. And I say, whichever way it breaks, I'll ride it for that day. So then on the 22nd, I ended up just riding it to the downside because it opened below here. And I was just like, okay, it looks like the sellers are not done here. So I'll ride this theme to the downside. And I used options, just long puts. I did have some short puts against it. And it was a ratio put diagonal. And I just ran it to the downside. And then I ended up getting stopped out because I needed to sell a lot of the long puts to cover the loss on the short puts. I always come out of those net positive. But what I don't like doing is taking the short puts down at a big loss, leaving the long puts on as an open trade, because then you can also lose on those too. If you take them down at the same time in this structure, you're essentially realizing the gains as you're realizing the losses. So it largely took me out of the trade. But that was just an agnostic move. And the way I came across it was seeing this thing making these giant gapping down moves and looking to follow the trend. Like that was pretty much it. Following a news-driven movement. And now today is really interesting to me because this shows me a different perspective now, where yesterday, nobody wanted this. And in my opinion, a big part of that comes down to the market still synthesizing how bad this is going to be, how impactful is this going to be, and how expensive is this going to be for CrowdStrike, right? From a company perspective, how much business are they going to lose? So as more of that information becomes ingested and the market is discounting that out, you'll see days like this where, okay, there's some people that say, it's not looking great, but I still like it at 258. I think this is a decent return on my risk. So even though it's essentially proverbially catching the falling knife, there are people that'll start buying it and they'll say, yeah, okay, this is discounted enough. I like it here. This is a decent bargain. And that's when you see people, I think, what was it? Did ARK build a position in here recently? I don't remember. There was a couple, let me double check that. Did ARK buy CrowdStrike? They did, yeah.
Uh-huh.
And I just remember seeing that coming out because I thought that was the kiss of death. I was like, maybe it's turning around. And then I saw ARK got into it. I was like, oh boy, never mind. That's obviously just a playful dig at ARK because they're just lighting money on fire. But that aside, it does show though that there are some funds that are like, this is at a point now where it's at a deep enough discount to where I think the value is, I'll step in front of it. And that's what this candle is. There was a lot of people that were still trying to sell it. And then it got to an extreme and people are like, meh, I like it here. I'll start buying it. And this starts to become interesting for a reversal. But again, this is still too early for me, at least on this kind of day. I need to see. But if this starts breaking back up above like this handle here, I start to become interested to trade it to the upside. I have no loyalty, upside, downside, circles, sideways. I don't care. As long as it's moving in something that I can ride, come along for the ride, that's what I care about. And so this is just an example of how I come across this kind of trade. This is more of an opportunistic style trade based on news.
So just one last question. What is the probability of out of the money? I mean, what goes in, what ingredients go into calculating the probability of an option being out of the money and what makes it vary?
Great question. Now, the first question is, when you're referring to it in this context, are we using the implied volatility of the stock, or are we trying to use our own volatility surface?
Well, like if you look at the option chains for all the different strike prices, you can see the column that says probability of OTM, probability of out of the money,
Got it.
and it has a percentage ranging from whatever fractions of a percent all the way up to
Yep.
99%. And then how
Yeah.
do we?
Okay. So that tells me we're using implied volatility. The reason why I
Ah,
asked that is because the way that you would calculate it in those two scenarios is different.
mhm,
So using implied volatility is very simple, right?
mhm,
So implied volatility, by its very nature, implied, is forward looking. What do we think volatility is going to look like going forward? And volatility is just variance. So in that case, you're literally just using, you can use Black-Scholes model to derive it out. You just take a partial derivative and you can literally plug in all the information yourself into a Black-Scholes model to literally answer that exact question. Another thing that people do use lazily, and it works sometimes for shorter term options, is delta. You can use delta because it's very close to the probability of an option being in the money. I actually have a video that talks about this exact thing because it's so fascinating to me how close they are and then how they deviate. So I'll actually show you in the options chain how this plays out, because the answer to, well, I guess the fun fact here is that delta, if you calculate an option's delta, it's actually very close to how you calculate the probability of an option being in the money. They're very similar. Now,
mhm.
if we look at CRWD and we look at, I know there's a lot of stuff, so I'll walk you through it. So we have delta here. Delta is 51 here. It's a 51 delta option. I'll click it, make it a little clearer. If we take a look at the probability of being in the money, it's 45%. This is actually a wider variance than you typically would see for something that's just 24 days out. The reason why it's so wide is because it's moving all over the place. So let me see if I can find a slightly more mellow example. What had like an inside day today? Maybe like XLF. That's typically pretty boring.
So just real quick in that example, is it the higher the IV goes,
Here we go. This is a
the
good example.
the lower the probability is of being in the money at that? I mean,
It would be the inverse. So the
inverse.
higher the implied volatility is, the higher the probability of bigger price swings encompassing surrounding options. So when I'm referring to, in this case, higher implied volatility for the underlying, not for the
Mhm,
option itself.
mhm, mhm,
So I'm moving over to XLF just because it tends to be more boring, and it's just a better
mhm,
example of like a more mellow market. Because the last time I completely betrayed you guys and I took us to GE, which just had earnings, so it's also very
mhm,
volatile. So
mhm,
looking at something like XLF, you'll see that the delta here is 45. The probability of this being in the money is 43. So pretty close, right? So we can objectively say that the math behind these two in this scenario is pretty dang close.
mhm,
Now, what's important for people to know is that if I go super far out, and you don't have to go that far out in time. Let's start though at like 300 days out. And I look at like that same 46 delta option. The 46 delta call now, this has a 40% probability. So it doesn't seem like as massive of a change in this case, but if you look at it as a relative change in the underlying itself, it's a really big difference. We now have a 6-point variance between the delta implied probability of being in the money versus the actual implied probability of being in the money. So all I'm showing you is a breakdown in the relationship between these calculations the further out in time you go, and it'll be more pronounced in things that have really high vol. So in this case, using the 16 OGs, the same example. So the 52% or the 52 delta right now is a 45% probability, right? So it's 45 and 3/4, but we'll just call it 45. And then if we go out again to like 332 and we find those same 51 deltas ish, the 51 delta call has a 32.99% probability. Massive difference. So if you're using delta as a back of the napkin probability, it's okay if you keep it short term. If something's really volatile or further out in time, that relationship breaks down massively, and you should use the standalone partial derivative to calculate an option's probability of being in the money.
Mm-hmm. Fantastic. So to wrap things up, did you have mentors or any books that you used to that
Yeah,
influenced your trading?
I did. So I had one mentor that got me into trading, but well, he got me into investing. I always give him a shout out because he's the one that literally sent me down this entire path. But he doesn't do any of this stuff. So, shout out for starting me down the path, but that's about it. And then I came across another guy that was an Army vet that helped me a lot. And he helped me in really painful ways. He didn't like take me under his wing and say like, here's what you do. Like there was none of that. He was brutal to work with. I would come to him with an idea and he'll say like, what's your plan? And you're like, well, I don't know, man. Like I didn't think of that yet. I just have an idea. And like, it's like that kind of where you have to come with the material. Otherwise he just does not care. So, but both of them were highly formative for me, especially the latter of those two, because it emphasized like anytime I would come to him like, I think this is going to go up or this is going to go down. And he would even go as far as to say things like, well, technical analysis is stupid. So then I'm like, I'm naturally skeptical. So then I'm, kind of taking him at his word, but then doing a bunch of research. And I actually find that there's pretty high efficacy in it, but I understand why he thought that because the way he used it, I agree, was stupid. But the punchline there is I did have somebody that forced me to much more deeply think through what I was doing. And that was worth its weight in gold, quite literally. So beyond that, the book side of things, I am over essentially since like the last 6 years, I've become just I read every single day now. I don't know what has become of me, but I've become a terrible nerd. But before that, I would say like if I were to think about options trading specifically, there's a handful of like must read books. The first one, they're literally two of them are right there. One of them is Option Volatility and Pricing by Sheldon Natenberg, right? Shelley does a great job and it's just a good general understanding of options. That book and then Options as a Strategic Investment are my two go-tos for pretty much everybody. The reason why I like Options as a Strategic Investment is because it's kind of textbook style, but it adds a lot of structure to what you're learning. If you're learning about options, it's overwhelming. It's the opposite of what I had when I first started. I started in 2007. So there was information, but there wasn't like bundles of information everywhere. Now it's like you walk down your hallway and you're smacked in the face with information. It's everywhere. So it's like straight up overwhelming, I think, at this point with how much data is out there. So that book does a really good job giving you kind of a clear textbook style roadmap. These are the options markets and, stuff like that. I think those are two great starter books. And then there's a ton of other ones, but I try not to overdo it on the book thing because it takes time to get through them and it can become overwhelming. I think sooner or later, though, the other thing I would add is just getting onto SSRN. And if you have an idea that you want to do in markets, you're like, man, maybe like MACD is the indicator. Maybe that's the one that that makes all the money. I literally would just type in like MACD SSRN into Google, see what research has been done on it already. And it really shortcuts how much personal research then you end up having to do. Because if you look at something, you read it across 5 different sources and it sucks in all 5 different sources, probably a pretty good output that this might not be that great. So those would be the 3 places I would start. I would do book by Natenberg, book by Larry McMillan, and then SSRN.
SSRN. Okay, great. Fantastic. Well, Erik, thank you for coming on Chat with Traders.
My absolute pleasure. Love hanging out with you guys. Thanks for having me.
Yeah.